So I've talked a lot about mutual funds, index funds, a little bit on stocks, small case, even gold. But one financial instrument I have, what's the word, consistently underplayed are ETFs or exchange traded funds. Honestly, that was a bit naive on my part because as of 2023, exchange traded funds globally have almost $11.5 trillion under their management. The Indian story is a bit more sedate, and while ETFs were launched in 2002, they remained rather non existent for over a decade. In fact, it was the government of India that gave ETFs a fresh lease of life by firstly recognizing it as an asset class in 2013, then making it a part of the government's disinvestment initiative in 2014. And what helped the most was the Employee Provident Fund Organization, the EPFO's decision to invest 5% of its incremental monthly inflows into ETFs, which has since gone up to 15%. As a result, what was an asset class of just 12,000 crores in 2015 is now over 50 times bigger, and I won't be surprised if over the next 10-15 years, ETFs go on to become an even bigger asset class as compared to mutual funds. It's quite a big statement, isn't it? Which means we have to start getting serious about ETFs and treat this video as a starting point as I take you through the basics of what an ETF is, how does it work, how it compares to index funds and stocks, its benefits, drawbacks, different types of ETFs, how to invest in an ETF, and a lot more. Let's begin. Okay, so to put it simply, an exchange traded fund or ETF is a tradable security that tracks either an index, a bond, some commodity, a bunch of stocks, or any basket of assets. So there are a couple of things in this definition. Firstly, there's the tracking of an index, which is very integral to the functioning of an ETF. And just as an example, something like a Nifty 50 index ETF derives its value by closely following and replicating the performance of the Nifty 50 index. Similarly, in the case of a gold ETF, actually look at this. So this graph here shows the price of 10 grams of 24 karat gold in India since the year 2016. Now, when I superimpose the NAV of any gold ETF, let's say the SBI gold ETF on the same graph, one can clearly see how dependent the ETF's trading value is on the price of the underlying asset it represents. The other key element in our ETF definition is the word tradable, which means an ETF can be bought and sold on an exchange during trading hours, much like how we buy and sell stocks on a trading platform. So, as the definition itself reveals, trackability and tradability are the basic foundations of any exchange traded fund. Alright, now let's look at the benefits of investing via exchange traded funds. I mean, surely there are advantages, right? Otherwise, ETFs would not have become an $11.5 trillion asset class. And just last year, ETFs globally attracted net inflows of $974 billion. So, kuch to hai. Actually, बहुत कुछ है. So, let's start with benefit number one. That is, ETFs are very simple to understand on account of its structure, in terms of diversification, definitely in terms of cost, and a lot more. In fact, ETFs are typically designed as a diversified portfolio, and much like how one buys a bunch of stocks, let's say you want to buy a bunch of FMCG stocks, then instead of picking a single share of, say, Britannia Industries at 4,700 rupees, one can own a piece of all or at least most of the popular FMCG stocks by opting for an FMCG ETF, which comes at a fraction of the cost. In that same context, ETFs are also super transparent as most of them disclose their holdings on a daily basis, and ETF prices are available on a real-time basis. The second big benefit is, of course, tradability, and ETFs can be easily bought and sold on the stock exchange with a real-time NAV, much like how an investor buys a share on any trading platform. It's an important benefit, and it's an apt solution to that one comment I often receive, which goes something like, if the market tanks by 5% today, then even if I buy units in a mutual fund, it won't be of much use to me because the AMC will process the transaction only tomorrow, and the market might have regained all its losses by then. If this is something that bothers you as well, then definitely take advantage of an ETF's real-time pricing and the ability to buy and sell these units during trading hours. A third advantage is in terms of choice, and as of now, there are almost 200 ETFs that an Indian investor can choose from. These are mostly passively managed, which is good because A, we get a clear understanding of the investment objective, and secondly, a passive strategy is very effective in keeping the costs really low. Actually, more than choice, I'm really impressed with the diversity. And today we have ETFs that cater to the broader market. So the Nifty 50, Next 50, Nifty Midcap 150, etc. There are thematic ETFs around banking, auto, pharma, IT, consumption, and others. Obviously, there's the quintessential gold and silver ETFs. Factor based ETFs or smart beta ETFs, as they are commonly called, are getting more and more popular with options around momentum, alpha, low volatility, quality, etc. Then there are international ETFs like those catering to the Nasdaq, the FANG Plus Index, the Hang Seng, etc. And not just equity, we can also invest in debt based ETFs that cover government securities, Bharat bonds, overnight funds, state development loans, and a lot more. My point is, unless you really want to do stock picking, the ETF universe in India has a wide range of options, and if an investor wants, he or she can make an entire portfolio out of these exchange traded funds. And finally, a fourth major benefit of using ETFs comes in the form of a low expense structure. And in a world where we investors are used to paying a scheme expense ratio of 1, 1.5, even 2%, ETFs come across as a breath of fresh air, with some of them easily going below the 0.1% mark. In fact, in 2023, a number of AMCs chose to cut down on the total expense ratio, and it started with Nippon India reducing the charge on its Nifty 50Bs ETF to 0.037%, which was soon followed by ICICI Prudential, which brought down the expense ratio on its Nifty 50 ETF scheme to just 0.0279%, which is probably the lowest total expense ratio for a Nifty 50 ETF amongst all mutual fund companies. I bet a lot of you did not know this number. I mean, yes, you had an idea that the expense ratio of an ETF might be cheaper than a mutual fund, but 0.0279%, there is no way you had thought that this number will be so low. Alright, now that I've covered the goody goody stuff with regards to ETFs, let's spend a few moments on some of the concerns as well. So let's start with the expenses. And while an ETF's expense ratio number might seem small, there are quite a few incidental costs an investor needs to incur, including a commission that your broker might charge when you buy or sell ETFs. Then there are the demat charges, STT, SEBI turnover fees, stamp duty, GST, the bid ask spread that one should never ignore, and of course, the market impact, which we'll study in more details in just a minute. My point is, because all these costs add up, at the end of the day, it's always better to have a view on the total expenses involved, and only once you have an understanding of that will you be able to decide if the ETF is cheaper or is more expensive than an index fund. Believe me, this can go either ways, but as a general observation and within the exchange traded funds, the more heavily traded ETFs around the Nifty 50 or gold have a much lower expense ratio as compared to the thinly traded ones. The second concern many investors have is on the liquidity front, which is another way of saying how easy or difficult is it to buy or sell an ETF as and when the investor wants to. Now, the issue comes in if you end up with a low liquidity ETF, because it's possible that at the time of wanting to sell those units, there may not be an equal amount of corresponding buy orders to execute the transaction. This part can be better understood by examining the volumes data on the NSE India website. So I've specifically pulled out the Nifty 50 ETF and symbols like Nifty Bs, Nifty I ETF, and Set ETF NIF 50, which are offerings from Nippon India, ICICI Prudential, and SBI Mutual Fund, have a much higher volume as compared to offerings by Invesco, Bandhan, and Tata Mutual Fund. Now, assuming I had 5 lakh rupees of Invesco Nifty 50 ETF to sell on this particular day, it's very probable I might not have been able to dispose of the entire lot because of the liquidity constraint with that ETF. In fact, liquidity has a bearing on the NAV of an ETF as well, and a less liquid ETF can display wild price swings depending on how big the buy or sell order is. In that context, and as an investor, be particularly careful about volumes when evaluating thematic, factor-based, or international ETFs. A third ETF related concern that many investors have is around the tracking error. So very simply, tracking error is the standard deviation between the ETF's performance and the performance of the index it is tracking. The tracking error itself is a function of multiple variables, so things like delay in the purchase or sale of securities, the ETF's cash holdings, any delays in the deployment of dividend, the expense ratio charged by the scheme, etc. And understandably, the smaller the tracking error, the more attractive it is to the investor, as it demonstrates the ETF's superior index replication capabilities. In fact, the news I mentioned earlier on ICICI Prudential and some other AMCs cutting down on the expense ratio is likely to have a positive impact on the tracking error, leading to higher returns for passive investors. And the fourth major concern for any ETF investor is the impact cost, which refers to the potential cost a buyer or seller has to incur for a particular quantity of order at a given point of time due to the prevailing liquidity conditions around that security. So essentially, this impact cost is a measure of liquidity risk and reflects the degree to which the ETF's market price is influenced by the size of the investor's trade. For example, take a look at this table here. Now, if a buyer wants 500 units of this ETF, it would be then matched against the best available sell order, which is 99 rupees. And likewise, if a seller wants to redeem 500 units, then the best buy order here is 98 rupees, giving us a bid-ask spread of exactly 1 rupee. But had this number been higher, let's say the buyer wants 1500 units, well, in that case, we have a slight wrinkle because while the ideal price is 98 rupees and 50 paise, the actual price is more like 99.3 rupees, which means the impact cost for 1500 shares comes to 0.84%. In other words, the less liquid the security is, that is, if the buyers and sellers are less in number, the longer it will take to execute the trade, which means higher will be the impact cost and therefore lower shall be your total returns. Now, an easy way of finding this number is to go on the NSE India website, tap on any ETF, and there'll be a placeholder there that says impact cost. Industry insiders often call the impact cost the hidden cost of an ETF, and with the figure ranging from 0.03 to 1.3% for the Nifty 50 ETFs, it is definitely in our interest to keep a track of this in addition to returns, expenses, volumes, and of course the tracking error. Yet another common inquiry are the key differences between exchange traded funds and mutual funds, more specifically index funds. Now, ETFs and index funds have a lot in common. After all, they both constitute a portfolio of assets, they both track some or the other index. The expenses are on the lower side, and both of them are passively managed most of the times. But there are differences and some pretty important ones. In fact, the biggest difference between index funds and ETFs is the impact of inflows and outflows. And in the case of ETFs, when an investor buys or sells shares, it does not directly impact other unit holders. What I mean is, when someone buys shares in an ETF, what the fund immediately does is that it creates new shares in the system, and when there is a sale, it's the existing shares that are redeemed, ensuring that the total number of shares in the ETF can be adjusted without affecting the existing shareholders. On the other hand, when an index fund investor buys additional units, it directly affects all other unit holders because now the fund must purchase more of the underlying securities to match the increased demand, which impacts all investors proportionately. And the same thing happens during redemptions as well, which is the reason why fiduciaries like trustees, financial advisors, investment managers, etc., have a preference for ETFs as compared to index funds. In addition to this, some other key differences include the fact that while the ETFs are listed on the stock exchange, which means anyone can buy and sell them during market hours, index funds aren't tradable on a real-time basis. You need a demat account to trade in ETFs, which is not needed when investing or redeeming index funds. SIPs are more aligned with index funds, although some stockbrokers are now offering SIPs for ETFs as well. And ETF's tracking error is generally lower than an index fund. As we discussed earlier, while ETFs are priced lower than index funds, one has to factor other visible and invisible expenses like STT, demat charges, GST, the impact cost, etc. And finally, speaking of impact cost, liquidity is not an issue with index funds as the fund house has to honor every buy and sell order, while that is not the case with ETFs. Alright, we've covered a lot of theory in this video, so let's look at how I use ETFs in my own investing. But mind you, these approaches might change over time as my own investing and as the products evolve, so always be on the lookout on how these things can be improved further. So firstly, I definitely use ETFs whenever there is a sharp dip in the market, so more of a tactical opportunity. And I remember the day the US elections results had come out. Now, here's a fact. Everyone expected Hillary Clinton to become the 45th president of the United States of America before this man trumped her, and in the process, he also spooked the markets with the Sensex and Nifty dropping by 6.5% on that day, which turned out to be a temporary dip, obviously, and therefore a profitable index buying opportunity. Now, I highlight this because had I used an index fund then, I would have gained almost nothing because this was a tactical opportunity, and every year a few such opportunities do appear, if not in the broader markets, then definitely across sectors like banking, IT, pharma, infra, and others. A second application of ETFs, at least for me, is when the difference in the expense ratio between an ETF and the corresponding index fund or fund of funds is a bit too high. For example, Aditya Birla Sun Life has a nifty Next 50 ETF which is presently at an expense ratio of 0.15%. Their corresponding index fund is, however, priced 20 basis points higher at 0.35%, which I think is a bit overpriced. And when I see something like this, I prefer to pick the ETF instead, which tends to be cheaper in spite of the incidental costs we discussed earlier in the video. Now, in addition to market dips and expense ratios, there are a couple more scenarios where I tend to prefer an ETF. Firstly, in a situation wherein I can't invest in an international index via a mutual fund, but I can do that through an ETF because the RBI had an additional limit of $1 billion. And then there have been cases where a particular factor was only available as an ETF and not as an index fund or as a fund of fund options. My point is, never be stubborn on the type of instrument you want to use to pursue your own investment goals. Over the years, my portfolio is a mix of actively managed funds, index funds, ETFs, and stocks, and each of these instruments have played a role in shaping and improving that portfolio. Okay, so very quickly, just like shares of a company, ETFs too have a primary market and a secondary market. The primary market is the first time allocation of ETF units, and it works a lot like a mutual fund NFO in the context that you apply for units during the NFO period, you pay the money, and units shall be allotted to you when the window opens. Once the initial allotment is done, the ETF is listed on the stock exchange, which is also called the secondary market, and further purchase or sale happens from there. Now, in order to buy and sell ETFs, you need a couple of things. Firstly, you'll need a trading account for which you can approach a broker like Zerodha, ICICI Direct, MStock, Grow, Upstocks, etc. And then you'll need a demat account with NSDL or CDSL for holding the ETF units. Now, when you search on your stock trading account, you'll notice that each ETF has a specific symbol by which it is identified. For example, say I want to pick some units in a Nifty 50 ETF. I'll start by typing Nifty in the search bar. Let's go with Nifty I ETF, which is basically ICICI Prudential's Nifty 50 offering. I'll then check the volumes and orders to have a sense of liquidity. I then click on buy, enter the number of units, let's say 100. I confirm the buy, and that's it. The order is executed and the units will be in my demat account by tomorrow, and that's how simple the buying or selling of an ETF is. Okay, this video has turned out to be longer than what I expected, but let me close this ETF explainer with a couple of more important points. The first is an inquiry I receive from time to time, and it pertains equally to exchange traded funds and index funds. So the questions many investors ask is, what does the ETF do with the dividend money that is received on the shares that the ETF holds? Well, very simply, and unlike what a few investors think, there is no hanky-panky stuff going on, and the dividends that are received by the ETF is reinvested back into the scheme, and it's only in some exceptional cases that dividends are credited back to the investor. In fact, on the part of the ETF issuer, it is important that this reinvestment happens as quickly as possible, because the longer it takes, the greater will be the chance of incurring a tracking error, which is something every ETF issuer wants to keep at the lowest level possible. A second point of inquiry amongst investors is on taxation, and while I'm no expert, here's what I have been able to compile from different sources. So, ETF returns are of two types. There's firstly the dividend income, which may or may not come about, but if it does, then this amount is added to the investor's annual income and shall be taxed per your income tax slab. The second type of return is the income from capital gain, and there are two variables to consider here: the type of asset class and then the holding period, that is the time period between the buying and selling of the ETF units. In the case of equities, ETF taxation is similar to equity shares and equity oriented mutual funds, that is, if the units are held for less than 12 months, then short term capital gain taxation applies at 15%, and if held beyond a year and for earnings in excess of 1 lakh rupees, the gains are subject to a 10% tax. When it comes to non-equity ETFs such as gold, debt, and international ETFs, well, post the April 2023 amendment in the Finance Bill, assessing tax liability on the basis of the holding period is irrelevant, and these are now taxed per the existing income tax slab rate. The one exception comes in the form of asset allocation ETF, where equities are typically in the 35 to 65% range. And in this case, if the units are held for more than 36 months, then LTCG rules apply, where these gains are taxed at 20% with indexation benefits. Taxes are important, so please do factor them when evaluating ETFs, in addition to all the other variables that we have discussed in this video. I sincerely hope this video has helped you better organize your understanding of exchange traded funds, and I hope you'll employ this instrument more effectively in the future. I plan to come back next month with another video on ETFs, so if you have any topic ideas, please do leave it in the comment section below. Once again, thank you for your time. Do tap onto that like button, share this video with your friends. If you haven't subscribed to my newsletter, kindly do so, and I'll see you next week. Until then.